Welcome back to the channel, everyone. Today I want to talk about the next stage of the stock market collapse. I want to talk about what's likely to trigger the next stage, how far the market is likely to fall, and how it's all going to play out. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, Mac 10 tweeted saying the S&P 500 is now back to being fully overbought on news of a confirmed recession. He said you can't make this stuff up. Looking at the S&P 500, the general trend over the last 6 or 7 months is obviously downwards. I drew a very similar line back in March and April. We can see over the last 6 or 7 months, the S&P 500 has oscillated around in this downward trending pattern, obviously moving up and downwards over the last 6 or 7 months. We've seen a number of what you could call relief rallies where the S&P 500 has bounced up, say 10%, before falling 15 or 20%, bouncing up another 10 before falling another 15 to 20% again. And as the Cabesi letter tweeted, he said we're now 12% off the lows for the S&P 500. That means the S&P 500 is in its third relief rally of 10% or more. And he said to put that into perspective, back in 2008 we had 5 separate relief rallies averaging 14%, and in 2001 we saw 6 relief rallies averaging 17%. Therefore, just because the S&P 500 is 12% off the lows doesn't mean the bear market and the recession is over. It likely means we're just seeing a small relief rally. Now you may say, Tom, the Fed haven't even admitted we're in a recession yet, therefore we can't be in a recession, therefore a recession isn't going to happen, and the economy is going to completely recover, no harm done. While I do wish this was the case, I think it's most likely a dream world circumstance. Mac 10 tweeted saying, I predict the market will be down 50% or more before a recession is officially confirmed by the NBER. Back in 2008, it actually took the Fed and the NBER a full year to admit the US was even in a recession. You could argue the last recession started back in December of 2007 when the S&P 500 peaked. In the July 2008 FOMC meeting, similarly to this year's July FOMC meeting, the Fed again said there was no sign of a recession in July 2008. It wasn't until December of 2008 the NBER actually decided, FYI guys, a recession actually began 1 year ago. So that was in December 2008, practically at the market bottom. Only then did the Fed and the NBER actually admit the US was in a recession. In the July 2008 FOMC meeting, similarly to what's just happened over the last few days, again the Fed back then said there was no sign of a recession and they doubted the US would see a recession. It seems like practically the exact same thing is playing out back from 2007 and 2008, but this time it could potentially be even worse. You may say, Tom, equities are currently on track to post the strongest monthly gains since late 2020. Surely the market is absolutely fine and the Fed is right, we won't be heading into a recession. But I think if you take a step back for a second, that means equities are posting the strongest monthly gains at a time when inflation is at a 40-year high, interest rates have just been boosted by another 75 basis points, and a recession has just officially been confirmed. That means stocks are currently growing faster than they were back in December 2021's peak, back in November 2021 and back in October 2021 as well. Stocks are posting their largest monthly gains at a time when the economy is going down the drain, when inflation is running out of control, the Fed is trying to boost interest rates to force the country into a recession to try and curb inflation. And I think that all points to the same sign, which is the market falling back down, setting new lows, and the S&P 500 will fall below 3,500 points. Following this downward trend, I expect the S&P 500 in September to fall below 3,400 points. Now, I think that's only the next stage of the current recession. I still don't think that's the final Hail Mary drop. I think that's just where the S&P 500 is heading to next. And guys, if you haven't already, be sure to sign up to Moomoo right now using the link in the description below. You can currently get 10 free stocks worth up to a total of $25,000. Moomoo is very easy to use, it's incredibly customizable, they've got tons of technical indicators and advanced charting tools. From Moomoo's latest customer agreement, they officially state they do not benefit from your order flow, and they do not sell your order flow to other market makers like Citadel or to clearing houses like Apex Clearing. In fact, Moomoo clear their trades on their own through their own clearing broker, Futu Incorporated, which does also not benefit from your order flow. Therefore, Moomoo is brilliant for buying those AMC and GameStop shares. Now, one of the reasons why I think that's where the S&P 500 is heading is because, as James just tweeted, he said reverse repo awards just hit their new record highest. The Fed overnight reverse repo award rate is the highest in history at 2.3%. If we look at the Fed's interest rate, previously the Fed was only paying 1.5%, but this has now been boosted to a whopping 2.3%. That's higher than the Fed was paying back here in 2019 during the previous liquidity crisis. Right now, as I said in a video a few days ago, we're again experiencing another liquidity crisis and low volume across the wider market. This is the Fed trying to incentivize these hedge funds and these institutions to invest more money and to trade more, offering a 2.3% interest rate for reverse repos. Now, you may already know, but the role of a repo and the role of a reverse repo in the financial markets is to provide an efficient source of short-term funding, but it's also to prevent market squeezes. It says institutional investors such as alternative investment funds borrow cash in the repo market to fund leveraged investment strategies on a cost-efficient basis, and also borrow securities to allow them to take short positions. It also says repos also mitigate systemic risk by allowing traders and investors who need liquidity in a stressed market to convert assets temporarily into cash in a way that's less disruptive than outright sales. Outright sales would depress the price of collateral securities and crystallize any unrealized losses on the holdings being liquidated or on hedges that have to be unwound when holdings are sold. Therefore, these repos and reverse repos allow these hedge funds to avoid crashing the market, generating additional liquidity so they can continue to meet their short positions and avoid FTDs. And the Fed is now having to offer even more money for other institutions to lend money into the reverse repo facility so other hedge funds and institutions can borrow cash or stocks. And therefore, I think something that could trigger the next stage of the market crash is this reverse repo facility spiraling out of control and many hedge funds end up being liquidated. If this reverse repo facility spirals further out of control than it already is, hedge funds and institutions will be forced to sell off their stocks instead of utilizing the RRP facility, further crashing the market. Something else I think could trigger the next stage in the market crash is a further collapse in the crypto market. You may have seen that Coinbase have just shut down their entire affiliate program, and they're also getting rid of Coinbase Pro. If Coinbase are having to shut down their affiliate program like BlockFi have done and like other crypto companies like Voyager have also done as well, maybe this suggests Coinbase are experiencing liquidity issues. On top of that, Coinbase is also facing an SEC probe over securities that they've listed. The SEC accuses them of listing illegal securities. It says the SEC is investigating whether Coinbase improperly let Americans trade digital assets that should have been registered as securities. Obviously, the increased idea of crypto regulation has been on the SEC's mind for some time now, and it now seems like they may be about to make a decision. If crypto is regulated further and these are deemed illegal tradable securities, then Coinbase and many other platforms will be facing huge backlash. Forbes Crypto also discussed the chances the SEC's investigation into Coinbase spills over or spilling over into other exchanges. Obviously, this could impact other exchanges like Binance and like FTX as well. If these exchanges are hit with massive fines, they could end up going bankrupt and going under, where billions of dollars in users' funds would effectively be lost. It would end in the collapse of more crypto exchanges, not just Voyager, but Coinbase, Binance, FTX, and many others as well. The crypto markets and the stock markets are so heavily correlated nowadays because many hedge funds that do invest in the stock market also invest in crypto as well. And obviously if these hedge funds that are investing in crypto lose hundreds of millions, if not billions of dollars investing in Bitcoin, they will be forced to sell off a large portion of their stock portfolio as well to cover the losses. Well, in fact, actually many of these hedge funds may end up being liquidated in their entirety, forced to sell off their crypto assets, and forced to sell off their stocks. This would obviously crash the market further, causing the next stage of the market collapse. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.